Let me just give a bit of background. Most of you will know that, but maybe some not. So the IMF every 6 months essentially issues something we call our flagship assessments as part of our multilateral surveillance role. So we do bilateral surveillance with individual countries, but also we kind of upgrade or aggregate all these individual forecasts, and we then think about how they fit together at the global level and think about policy challenges when you aggregate this, all these country forecasts. So this is what happens in the World Economic Outlook, but we've added to that in the last years 2 more publications. One is called the Global Financial Stability Report that focuses more on financial sector issues, and then also we have a Fiscal Monitor that once a year in the spring kind of gives an overview of fiscal developments globally, but because fiscal positions move slowly, the other part of the year in October it typically focuses on a specific topic. This year it focuses on fiscal policy and inequality. I'm not going to talk much about that, but I'd invite you, and the purpose of this discussion here or presentation is really just to whet your appetite, and hopefully you can go and look a bit further. There's always a conjunctural part which I speak more about, but there are also analytical chapters in all of those publications that provide a richer analysis and that you might find interesting. So let me start here giving away the family silver at the beginning, just a quick kind of big picture overview, and then I'll drive a bit more into some of the issues. I think the big picture view is that the economic activity globally has gained some momentum. It started in the second half of last year and has continued in the first half of this year. And the outlook now is for higher growth, both in 2017 and 2018. And higher means both higher compared to the previous year, but also a little bit higher than what we previously thought. Now the big picture of the composition of this growth hasn't changed too much from our assessment in April. Essentially, advanced economies are growing slightly above their potential. They are catching up, they are closing output gaps for most parts, but they're then expected to fall back again at their potential growth rate, their lower potential growth rate. So we have a little bit of a spurt in the short term, but then relatively modest growth going forward. And then emerging market economies are expected to recover as a group, but that also mostly reflects really the recovery of some of the larger emerging markets that have been in recession recently, mostly commodity exporters. So they are finally coming out of their slump, but also their growth is not expected to be as forceful as it was earlier when commodity prices are higher. In terms of risks, I mean, the IMF, we're sometimes called that we are paid to worry. So of course the risk assessment is always a big part of these publications. The risks are still tilted to the downside, and maybe not so much in the very short term, as the recovery this year looks quite solid, but certainly over the medium term. Now in terms of policy priorities or policy advice, I think in light of the more positive outlook, we see the current conjuncture as a window of opportunity to advance on some structural reforms. As our managing director said when she kind of presented this overview, she said, well, you fix the roof when the sun is shining. While the needs vary, I think one big topic is really supply side reforms to increase potential growth across both advanced and emerging economies. That is one common theme. So I'll get a bit more into all this going forward. Let's start first a little bit with the setting, the global setting in which we are finding ourselves currently. So first of all, really financial markets have been quite buoyant since the spring. If you look globally, both across advanced economies, but also in emerging markets, bond yields have fallen, and also equities have performed quite strongly. Partly that reflects really that expectations of fiscal easing that we had right after the election in the United States in November haven't really materialized. So the market is more sanguine in that perspective. And the increase in bond yields we saw right after the election, which is, you can see the yellow dots there, they have subsequently reversed. Very, very recently, and from September on, there's been a slight increase, but really minor. But so, after the initial kind of volatility we saw after the U.S. election with higher bond yields, essentially there's now an expectation that fiscal expansion will not be that strong, and also that as a consequence, the pace of tightening, of monetary tightening, or unwinding of the very accommodative monetary stance in the US will be relatively slow, and that in part has driven the equity performance also in international markets. It's been a very good time for emerging markets in terms of their financial conditions. Right after the US elections, we were worried that the tightening of monetary policy, especially in the US, would negatively affect emerging markets' capital inflows. But we haven't seen much of that. On the contrary, 2017 has been a great year in terms of portfolio inflows. You can see the different colorings here on the chart reflect different regions, and the inflows have been really across regions, but especially strongly in Asia. Asia has been a big recipient of capital flows. They've been quite strong, partly reflecting, of course, also the stronger growth fundamentals in the region. But there's clearly also, of course, a search for yield ongoing by non-residents, and I'll get to that a bit more later on when we talk about financial sector risks. Here we go. On the exchange rate front, especially real exchange rate, I think the big story has been dollar weakness and euro strength. Again, dollar weakness reflecting a reversal of expectations. You can see here again in this chart we have the three different time frames. The first is right after the US election up to March. The yellow dots, you can see that the dollar tightened, initially strengthened in real effective terms, and then afterwards the period from March and August that completely reversed this. On the contrary, the dollar weakened. And you see the reverse pattern in Europe. That reflects also positive news that come out of Europe in terms of economic activity. The picture in emerging markets in terms of real effective exchange rate development has been a bit mixed. You can see this also for India. Appreciation first and a little bit of depreciation. Some markets have a quite strong fluctuation, such as Mexico, where you have seen recently a quite strong appreciation after the initial negative impact on the Mexican peso from the US election. So it's a bit of a mixed picture, but essentially the euro has strengthened in real effective terms, and the dollar has weakened since we last looked at the global economy. Commodity prices, important for India. The first half of the year has seen a little bit of softness in commodity prices, but more recently they have picked up a bit. For the year as a whole, when we look at averages, we still expect actually a quite significant increase this year. The total commodity price index is expected to go up by about 12%. Sorry, this is the average petroleum spot price. Sorry, yes. And again, it's a bit across the board, in both in petroleum and also in non-fuel commodities. But from there on, next year already, we essentially have a flat forecast. And if you look at futures prices, they only point toward a slight increase in commodity prices by 2022. Now, experience tells me that the longer you look out, these futures markets, the less reliable they are as a forecast. So, of course, this has to be taken with a grain of salt. but in January, after a bit of an increase this year, we don't see much action going forward, at least in the next year, in terms of the commodities. Now just a last look at short-term activity indicators, because before we go into the forecasts, as I said, economic activity picked up in the second half of 2016. As you can see here, we have the manufacturing PMIs on the left side for both advanced economies and emerging markets. So we see a co-movement there, an improvement. And also we see that consumer confidence across both emerging markets and advanced economies have increased. And the most recent data points also point up, which is a good sign that probably not just in the first half of this year, but also in the third quarter, activity globally was quite resilient. So with this in mind as a background, let's look at the global outlook. And we like to think as two types of forces shaping that outlook. On the one side, we have kind of ongoing realignments, or some we want to call it high frequency or short-term forces that are acting. On the side of the advanced economies, as I was mentioning before, we have a cyclical rebound in advanced economies that are growing faster than potential in the short term. The extent of rebound depends a bit also on the degree of post-crisis repair. Some of the European countries have made less progress there, and they're growing a bit slower. But others, like Germany or Spain, are doing quite well, especially in Europe. And the US is growing, actually has closed its output gap already, is growing quite fast. On the emerging market side, there's continued rebalancing in China. I'll get into that a little bit later on. Exporting countries, commodity exporters who have been hit hard, are adjusting to the lower commodity prices and are coming out of recessions. And then there are quite a few countries where geopolitical and domestic political factors are in play. The Middle East, of course, but also in Latin America and a number of countries there are domestic political strains, Venezuela, Brazil. So that also has an impact. And then this is overlaid on some longer term or ongoing trends. Demographics is a big trend. Clearly a headwind in advanced economies. More mixed in emerging markets, for many emerging markets, including India, and that is early in the stage of demographic transition. This can give some tailwinds, but there are other countries like China where already the demographics is starting to exercise a drag. And then across both advanced economies and emerging markets, we see very sluggish productivity growth. So a slowdown that started already before the global crisis, and it has not reverted, and that's a common theme, although sometimes to a different extent between both country groups. Quickly to the to our forecast here. So if you look at the first column, you see global growth is expected to accelerate from 3.2%, which was a multi-year low in 2016, to 3.6%, and then a little bit more to 3.7% in 2018. As you see, a slight upward revision from our July forecast, which is the last one that we had published. And looking across advanced economies on this chart here, I would say two things. First of all, advanced economies also are accelerating significantly from 1.7 in 2016 to 2.2. And this is the growth above potential I was talking about to close output gaps. But you see already in 2018 we are projecting a slowdown to 2%. And our medium-term expectation of potential growth for advanced economies, I believe, is slightly under 2%, 1.7, 1.8. The one thing just to mention here, I will not go into detailed country forecasts here. I invite you to look at the World Economic Outlook if you're interested in a particular country. But I think the one thing that is visible here, it's a fairly broad-based recovery. So I think we've said we haven't seen such a broad-based recovery in advanced economies in some time. So this gives us also a bit of confidence, at least for the short term, that you know, in the forecast, and as I was saying, in the short term, and I say afterwards, the risks are a bit more balanced. Let's spend a bit more time on emerging markets here. Again, also in emerging markets, we have an acceleration of growth from 4.3 to 4.6 in 2017 and 4.9 in 2018. And on aggregate, really, our forecasts haven't changed much, but there have been significant changes in the composition of the forecast. And if you look right to the main emerging market economies in terms of their weight, you see that China is actually accelerating this year, or projected to accelerate, slightly better than we thought before. But where we have made a quite significant adjustment is India, where we took down our growth forecast for this year by 0.5 percentage points and somewhat less next year. And then on the right, you see Brazil and Russia, which are the emerging market economies, commodity exporters who have been suffering quite severe recessions and are now finally coming back into positive territory. Let me talk a bit more about this here. One thing I wanted to emphasize here that, first of all, emerging market economies continue to be the engine of global growth, the main engine of global growth, and that is especially true for Asia's emerging markets. So if you look here, here's the kind of contribution of different regions and countries to global growth. And you'll see that growth in India and China makes up for about half of growth in the world. So, and that is not expected to change, on the contrary. So global growth really depends to a large extent on the success of emerging markets, on continued convergence of emerging markets to the income levels of advanced economies. I will spend a little bit of time on China, given that it is also one of the risks that we see for the outlook. First of all, I'd say that there have been quite dramatic changes in the structure of the Chinese economy in the past 10 years. If you look at the left chart, you'll see the savings and investment balance. And you clearly see how China has reduced its reliance on external demand. The difference between national savings and investment is the current account deficit. And you see over the years there has been both essentially a decline in investment, but also a decline in savings, which means an increase in consumption. So growth has been shifting from investment to consumption as a main driver, and as a result the current account deficit has shrunk from 2-digit levels to, I think, roughly 2% currently. And on the other hand, if we look a bit more on the supply side, you will see that in terms of the structure of the economy, China has moved dramatically away from industry and more toward a service-centered economy, with services share in the economy rising in the last 15 years from 40% to about 52%, and industry declining quite a bit as well. Now, there is more way to go. If we look at other countries, let's say Australia, for example, has service sector or more advanced economies, and some emerging like Brazil have services shares of 70% of GDP or even more. But to compare with South Korea, for example, South Korea has a 60% services share. So we believe this is a process that has not yet run its course and will have to continue going forward. But a less investment-driven growth should also be beneficial to address some of the vulnerabilities that we see. And here we go on the next chart. And I think the overarching problem that China has been facing has been that the pace of debt accumulation, both in the private and public sector, has far outpaced GDP growth. And you can see this on the left side here, with a strong increase in the non-financial sector debt here in that chart. This is, of course, a risk, and our forecast on the right side, you see the scenarios. This is from the Article 4 consultation, the annual bilateral consultation. You see the red dark line is the baseline, and it is looking for a fairly continuous decline in growth, an adjustment of growth, and to the extent that stimulus is being continued and this deceleration of growth is held back, of course the risks to the forecast rise. You see the projection range around the baseline is quite large, so there are downside risks. There could be a bumpy adjustment. Now we do see an alternative, which is to decelerate somewhat faster in the short term, to adjust faster, to rein in credit growth in the short term, and maybe provide a little bit of fiscal support. It would be the blue line, but that would allow then to grow in the outer years higher than what we currently anticipate. So taking up a bit more pain upfront could pay off in terms of having a higher growth in the medium term. But what is important, I think, going forward when we look at the medium-term growth rate, is that China's growth is clearly expected to decelerate. So the high growth rates we've seen in the past are not expected to continue going forward. China will have to grow more slowly. And that, of course, raises the question, who will pick up the slack? Who will keep emerging market and therefore global market growth, global economic growth high? Oops, sorry. Apologies. Just quickly on India. Well, India should in part pick up China's slack. And as I said before, we had downgraded our short-term growth, essentially following the numbers in the first quarter. We see that both demonetization impacts are still lingering, and also the GST implementation costs, implementation distortions have been higher than what we anticipated, and we see then essentially growth bottoming this year and then gradually increasing. For the medium term, we still think that growth could rise a bit further. Some of the structural reform that have already been implemented, such as the GST, will probably provide some impulse to productivity growth, especially if the structure is adjusted from its current structure. And but also really to reach those growth levels in the medium term, we would have to see a continued pace and a continuous pace and of quite ambitious structural reforms. I'd not be talking too much about policies in my presentation, but I'm happy to talk about that when we are in the discussion. Now, this global recovery falls short in a few areas, let me just, in the interest of time, focus mainly on the first one, which is that once we look beyond, so once we look beyond the immediate, the next 2 years, what we see is that global growth is only forecast to grow marginally in the outer years. So our forecast globally for 2021 is only growth of 3.8%. So essentially growth stays flat. The recovery ends here. And basically this reflects what I mentioned before, the reversion of growth in advanced economies based on the demographic pressures and also a sluggish productivity growth. And it also will depend critically on what I mentioned to you, that China's growth slowdown is being compensated by a pickup in other emerging market economies. But generally, if you look at the outlook, even though we're happy with the recent pickup, it is not an outlook that tells us that we're going to go anywhere back to growth rates as we'd seen before the global crisis. There's an issue also of low inflation still, especially in advanced economies, where core inflation really still has failed to decisively get back at levels close to central bank targets around 2%. But let me skip through that in the interest of time and talk a little bit about risks and policies. So in terms of the near-term risk, we feel that global financial stability risks have declined slightly since our last assessment in April. This is a bit of a complicated chart, so let me just explain it in 20 seconds. The upper side essentially are different risk factors for financial stability, and the farther out you are on that spider web, the higher the risks are. And on the lower part we have monetary conditions and financial conditions, and as well as risk appetite. And so the farther out you are there, the higher the risk appetite, and the more accommodative the financial conditions. This gray area is where we were just after the financial crisis. So very high risks all across emerging markets, advanced economy, credit risks, high risks to liquidity, and very tight financial conditions, and very little risk appetite. Now the red spider web, the red web, is our assessment in April, and the green one is the one now, and you see that the risks have come on quite a bit from the heights of the crisis. In fact, in this assessment we think that emerging market and macroeconomic risks generally are lower, and that simply reflects the fact that the economy, global economy, is picking up. The recovery is better anchored. And what we also have seen is that risk appetite has increased. You see on the lower right side. The search for yield is clearly on. And of course, we'll talk about this in a second, but it's a double-sided sword, this increase in risk appetite. Here we go. So one thing that we see globally is that financial market valuations are stretched. Asset valuations have continued to rise, and that has really driven down a whole set of compensations for risk. Here you see market risk and term premium risk together, and you see that that has come down really to historically low levels, both for emerging markets, but also for high yield, also for risky investments in advanced economies. And in a way, of course, this is an intended consequence of accommodative monetary policies. You want to encourage risk-taking. But on the other hand, of course, there can be too much of a good thing, and these highly compressed term premia and credit risk premia, as well as very low volatility, which we've seen, have just come together with this compression. They could potentially decompress quite quickly in case of unexpected shocks. And therefore we could suddenly be confronted with a bout of financial market volatility. We saw this at the taper tantrum some time ago. There was a little bit of volatility around the US election. But this is clearly a risk going forward, that we have a very, very compressed risk premium out there. And if there's a reassessment by investors about the compensation they need, we could see fairly large fluctuations. The key challenge here, or the source of volatility, could of course be the reversal of this massive expansion in balance sheet in major central banks in unconventional monetary policies, and against the background of slightly different monetary policy stances across the major banks. So we see the US is tightening its monetary policy already, and the market expectation is of a fairly gradual tightening. The UK tightening somewhat more steeply, but we see expectations for Europe are still to be for quite some time accommodative, and especially for Japan also. So now we will come into a situation where major central banks will have slightly divergent monetary policy stances. And as I said, much hinges, how this process evolves, hinges really on avoiding surprises and essentially avoiding these bouts of uncertainty and sudden spikes in risk premium in the market.
On this left diagram,
yes,
Have you merged UK with Euro?
No, UK is grey, no?
No, that's on the right.
No, that's the left. No. UK is for the left. Sorry. Yeah, it didn't fit in there, so I put it on the side. Sorry for that. Yes. UK is grey. Yeah.
I just saw it.
Yeah. No, that would have been a cardinal sin if we had done that, I think.
Why is Japan repeated twice?
That is just a mistake. Right. So no, the red line is the aggregate. Sorry. Yes.
Japan is the yellow sheet.
Yes, please. Yes. Japan is yellow and the US is green. Sorry, India. And so where is the risk? Just one more thing from the Global Financial Stability Report. So the Global Financial Stability Report looked at the potential for spillovers to emerging markets, essentially trying to disentangle how much of the quite substantial portfolio capital inflows of to emerging markets has been driven by really this extraordinary expansion of monetary policy. And if you look at the light blue part of these bars, you can see that a substantial amount, actually about 260 billion of a total of 380 billion of inflow since 2010 can possibly be attributed to the Federal Reserve quantitative easing. So what that means, of course, is that to the extent that quantitative easing gets reversed, some of these capital flows might also reverse. The GFSR puts out an estimate of that there could be some outflows of 35 billion a year. Now this is outflows relative to a baseline, so of course there will be other forces that will attract more capital, which again this would seem to be an amount that is manageable. It will probably affect more the countries that have seen higher inflows in the period leading up to now, countries such as Mexico or South Africa or Chile. India hasn't had such a large share in inflows, reflecting partly also the existing controls. So it would presumably be affected less. But again, how much outflows there could be will depend on how much volatility is in the market. If there's a large reversion of risk appetite, of course, these outflows could be higher. So the main message here is that there can be volatility, there are risks in the market with the current valuations, and so countries should be prepared for that. Overall, as I said already, risks are tilted to the downside, especially in the medium term. The short-term forecast, I think, our teams are quite confident, and the latest high-frequency numbers actually support the idea that the recovery is quite strong, or at least broad-based and sustained. We talked about some of the financial tensions already that I just mentioned in the last 4 slides, so I will not repeat them. There are other issues. Again, there is still some crisis repair to be done in European banks that are being mentioned. You can read more about that. There is, of course, currently a debate about reversal of financial deregulation in some sectors that might carry some risks as well. But there are other risks. As we know, of course, we have seen slow growth of median income since the global crisis, especially in advanced economies. And there have been now also rising sentiment against the globalization and integration, and therefore, of course, to the extent that some of these distribution issues are not addressed, we could see a reversal of pressures to retreat from the trade integration, the financial integration that we've seen, and we would think that this would be negative for global growth if that materializes. So far, we haven't seen too many concrete examples. It's been more of an articulation of these grievances, but of course the risk is there. We talked about low inflation advanced economies as well, and then there are all kinds of geopolitical risks that are always on the table. A few more slides to finish. Just in terms of policies, as I said at the outset, we see a window of opportunity to undertake structural reforms. In advanced economies, again, the policy needs and the policy stands and the reform needs depend. There are some countries that still need cyclical support if output gap is still there. In others, such as the US, the output gap has essentially been filled, and therefore the support can be withdrawn. I think key issues that we see across both sides is the need to undertake reforms to address sluggish productivity growth. So supply side reforms are quite important. And of course, advanced economies that have accumulated a lot of debt over the last years, there have to be really now credible strategies to address, to bring the debt back to a sustainable path. On the EM side, emerging market side, China as a rebalancing is the key issue. Some actions have been taken there, and we hope they will continue. Also in emerging markets, the need for structural reforms is of course there. Just very quickly, 3 slides on the implications for India. What does this environment mean for India? I'd say that external conditions for the next couple of years probably look a little bit mixed. This chart here is showing you the terms of trade windfall gains. You see the blue bar is 2015, and sorry, I didn't mark the Indian bar, but it's the 4th from the right side. You see that India was a very, very big beneficiary of the decline in oil prices at a large terms of trade shade.
Could you explain what do you mean by saying 3% of GDP?
This is essentially the income transfer that has happened from the decline in oil prices. And that extended a little bit in 2016. But as you see for this year, with oil prices rising, and there will be a little bit of drag from that perspective, a little bit of a drag on national income. And for 2018, so this is for fiscal 17-18 as well.
It's better.
It gets slightly better, but still slightly negative. So there's still a little bit of drag in terms of on national income. So national income will be a bit lower by commodity price changes. But it's not a large effect. So kind of not as great as before. And I think some of the slowdown we've seen also reflects that this tailwind from low oil prices has faded. So there will be a little bit of a headwind, but not too strong. We think financial conditions will generally be supportive as well for emerging markets, but again, maybe not as supportive as they were earlier this year. So the external environment, I would say, kind of so far so good. Not as great as before, but also not bad. I think where we have an issue here is if you look back at external export demand or external demand, here we just plotted the projected real GDP growth rate of India's export partners for the next 5 years. And you see in 17-18 we see some pickup in growth in the export partners. So there will be a little bit of a rise in external demand. And if you look at the most recent export data, you would see that there's a greater dynamism there with some fluctuation around the GST implementation, etc. But at least in the short term, demand will rise a little bit. But then if you look at the outer years again, and it's not surprising because we said that global growth in the medium term is not going to be very strong. So India, of course, trades a lot with countries that are not all that dynamic, especially advanced economies. And that means that really export demand from those traditional export partners will not be all that strong going forward.
This is goods or goods and services?
This is just goods. So yeah, this is just goods. I think the export demand for services faces some other issues which have more to do with...
so we don't get the country-wise services exports. So we're not able to attribute weights to the country partners. With services, we see the name of the country, that's the destination. Sorry, with goods, we see the name of the country,
yes,
that's the destination. So you could, this is a very nice and useful graph.
Mm-hmm.
But we can't do this for services because we don't see the names of countries.
Yeah, you're right. I think for services, I mean, of course, the underlying, given the structure of services, of course, the underlying growth is also important for those services. But I think, especially in the service industry, in the IT industry, you have kind of a lot of technological change at the moment, with some of the services India has been offering being essentially replaced by artificial intelligence, etc. So there's a bit of structural change ongoing as well. I don't see that much change on the goods side, but you're right. So this was just focusing on goods. Finally, I was talking about the possibility of financial volatility. How well is India prepared? I think India has when we look at its external vulnerabilities, India has come a long way back from 2013. today a much lower current account deficit, partly for conjunctural reasons, essentially a better in terms of trade, lower oil prices, but also some structural adjustment. But also the reserve coverage is quite solid. And especially in the structure of some of its liabilities, we see a big difference with other countries. So if you look at corporate leverage in India, it is quite high, or in line with other emerging markets, but the structure is very little external liabilities there. If you look at the sovereign balance sheet has very little external debt there as well. So there are a number also in terms of the structure of the liabilities that do protect India to some extent. So we see, of course, India will never be immune to global financial volatility, but in terms of its vulnerabilities, we do think that it is actually in a quite comfortable position to address these. And of course, I should have also mentioned the exchange rate. So just a summary, what does that all give us? In terms of trade, it's had somewhat of a drag. Financial conditions a bit less buoyant, but still generally supportive. External demand, short-term good. Later on, not going to be very buoyant. Implication, well, with all of that, I think the main message is that really what matters for India going forward and for the medium-term outlook is domestic policies and domestic reforms. They will really determine whether India can step up to a higher orbit of growth, or whether it will remain more in the 6 to 7% range that it's been now for a while. So I leave it there. I'm happy to discuss any of these points, or also any issues about India.